Right, we're going to have a look at this retirement question now. So partnership retirement question with a revaluation of assets and liabilities. So if you remember, partners will often decide to revalue assets when a partner retires or when a partner is admitted. So often things like property may have gone up in value. So it's only fair that the old partners are rewarded for that, and that any new partners coming in don't get the benefit. So we've got Chandler, Phoebe and Rachel who have been in partnership for a number of years. They share their profits and losses in the ratio 3 to 2 to 1 respectively, and there is no provision in their partnership agreement for interest on capital or interest on drawings. So quite straightforward partnership agreement. Chandler has decided to retire at the end of their financial year on the 31st of December 2019. Any amounts outstanding to or from Chandler upon his retirement were settled via the firm's bank accounts. That means there was enough money to pay him any balance in his capital and current accounts. So remember, when a partner leaves, we have to work out how much is owed to them and either pay them the balance or maybe convert some or all of it into a loan account, which would be shown on the partnership's statement of financial position. But it tells us clearly here that they paid it out of the bank account. So we have to remember, when a partner retires, we have to close down all of their account. So any current account balance that you can see here, so we've got current account balance of 4,600 overdrawn, is going to be set off against the capital account balance, which is a credit balance of £36,000. Okay, but that's probably not going to be the final balance because we've got some stuff to do with retirement, possibly even Goodwill. So sometimes they'll value Goodwill, but we need to read on to find out. So an extract of the balances on their book shows that they had property at cost, 240,000, motor vehicles worth 92,000, inventory of 31,134, trade payables at 19,294, and a bank balance of £18,000. So that's money in the bank. It doesn't mention an overdraft. Now, under additional information, and remember that the additional information is always given to us for a reason, it's telling us that the property was purchased on the 1st of January 2013. So let's just think about how long we've owned that for, because we are going to have to work out the depreciation here. If you look, property at cost is given 240,000, but we're not told about how much depreciation to date. So remember, obviously when we revalue an asset, we revalue it upwards, we have to eliminate any depreciation on that revaluation of the revalued property. So the property is depreciated 1% per annum using the straight line basis. A full year's depreciation is provided in the year of acquisition, none in the year of disposal. We haven't disposed of it, but we're dealing with Chandler, who's retiring on the 31st of December 2019. So let's count on our fingers. First year end that we had this property was the year end of December 2013. That's 1 year, 2014, 2015, 2016, 2017, 2018, 2019. So it actually is 7 years. Now you might be forgiven for thinking 2013 through to 2019 is 6 years, but we need to add one on because it was there for the whole of 2013. So just, if you're not sure about it, count on your fingers. The year ended 31st of December 2013, 14, 15, 16, 17, 18, 19. So 7 years worth of depreciation. So depreciation on the property is 1% per annum, so it's 240,000 times 1% times 7 years. So I'm not taking any chances. I'll use my calculator for this one. So 240,000 times 1% is 2,400 times 7 years is 16,800. So that means that the net book value of the property, 240,000 minus 16,800 is actually 223,200 at the moment. Okay. So what else do we need to know about? We'll deal with the revaluation in a minute, but motor vehicles were purchased on the 1st of July 2015. These are depreciated at 20% per annum using the straight line method, but on a straight line basis, but depreciation is charged monthly on a time apportioned basis. basis. That's annoying, isn't it? So they were purchased on the 1st of July, which by my reckoning was halfway through the year ended July 2015, and they're depreciated 20% per annum using the straight line basis. So we need to find out what they cost. The cost was 92,000, and then the depreciation to date on those. Let's have a look. So yeah, we've got 6 months in the year to July 2015, 2016, 2017, 2018, 2019. I reckon it's 4.5 years worth of depreciation. So it's 20% per annum straight line. So times it by 4.5 years. So 4 years and 6 months. So if you think about they bought on the 1st of July, so July, August, September, October, November, December, it's 6 years up to July 2015, and then 2016, 2017, 2018, 2019. So let's work that out then. 92,000 times 20% times 4.5 years is 82. 92,000 times 20% is 18,400. I don't know what's going on with my calculator. Bad workman here blaming her tools. So 18,400 times 4.5 is 82,800. That just seemed like an awful lot. So 82,800, which means that the net book value is this 92,000 here minus the 82,800. So the net book value on those assets is £9,200. Okay. So in terms of revaluation, then the property is going up to 254,000. So we need to compare that. So the revaluation, £254,000. The increase on the property is the difference between those two. So there's an increase of £30,800. Okay. And then on the motor vehicles, the net book value is 9,200 and the revaluation is 22,050. Reval. So it equals an increase, the difference between those two, 22,050 minus 9,200 is £12,850. Okay, so that's two assets that have gone up in value, motor vehicles and property, but the inventory has gone down in value. So if you look here, the inventory is 31,134, but over here it's been revalued at 28,344. Presumably there's some obsolete inventory in there. So we've got 31,134. The difference is a reduction of 2,790. Okay. So it's asking us to prepare the revaluation account for the partnership. So we're going to have to take these three things into account. And remember that any increase in revaluation gets credited to the partner's capital accounts, and any decrease gets debited, and it's in their old profit sharing ratio. So let's draw up a revaluation account then. Let's do a nice T account here. So remember the revaluation account, it's a bit like the suspense account. It takes the other half of the entry. So when we increase the value of an asset, we debit the asset and we credit the revaluation account. So if we start with the property, that's gone up in value, look over here, by 30,800. So we're going to debit property with 30,800 and we're going to credit the revaluation account with 30,800. Okay, motor vehicles have gone up in value by 12,850. So we'll debit the motor vehicles to increase their net book value. So 12,850, 12,850. Oops, wrong one. And we'll credit the revaluation account. If you remember, the inventory has gone down in value over here by 2,790. So we're going to credit the inventory at 2,790 and debit the revaluation account. Okay. So now what we need to do is work out what the overall balance is. So we've got two increases that total 43,650 on the credit side. We need to take away the 2,790. So the overall increase, I'll just write it down the bottom here, is 40,860. So when I net the increases and the decrease off against each other, we've got an overall increase of 40,860, and that's going to be credited to the partners' capital accounts in their old profit sharing ratio, which we have a look here. So it's for all three of them, Chandler, Phoebe and Rachel, 3 to 2 to 1. Oops. 3 to 2 to 1, so we divide that by 6, 40,860 means that Rachel gets 6,810, Phoebe gets 13,620, and Chandler gets 20,430. So the revaluation account, like the suspense account, has to come down to 0 at the end. So let's just make sure that both sides do add up. 43,650 on that side, and 43,650 on that side. So that's the revaluation account done. Now the other thing it asked us to do was to prepare the capital account for Chandler. Now Chandler is the one who's leaving, so remember his capital account needs to be cleared down. So Chandler capital account. First thing we need to do is get the opening balance from his capital account in there. So back onto page 1, the opening balance on his capital account was £36,000. We've got LBD, £36,000. And if you remember, he had his current account, it was overdrawn, I think by £4,000. Let's just check that. The current account, £4,600 overdrawn. So we need to credit the current account, debit the capital account, £4,600. And then remember, he's got some transferred from the revaluation of assets. So his share of that was 20,430 from the revaluation account, 20,430 pounds. So final thing we need to think about now is how much we owe him. So we've got 36,000. Oh, is there Goodwill? Sorry, let's just have a look at the Goodwill valuation. I'm just trying to check if they had any Goodwill. I don't think they did they? No. So no adjustments for Goodwill. So it's just a case of paying him the difference in the bank account. Yeah, there's no Goodwill on this question. I was thinking of a different question. So all we've got to do is make a transfer to the bank. So 20430 minus the 4,600. So we are going to have to pay Chandler 51,830. So let's hope they've got plenty of money left in their bank account. So once we've done that, Chandler is now no longer part of the business. He's got no balance in his current account, no balance in his capital account. They're both cleared off. He's been paid his nice big check, 51,830. You can skip off into the sunset with that and leave Rachel and Phoebe to carry on. So hopefully that explains that one. And you can have a go at the other questions.